What is going on, guys, and welcome back to another very exciting video. In this video, we are going to be taking a look at Bank of America and how it compares to SVB. A few days ago, we did a video on SoFi Technologies and how it kind of relates to everything that's going on with the SVB situation. If it's in a bad spot, we're going to do a very similar video, but for Bank of America. And then at the end of this video, what we're actually going to do is we're going to take a look at their PE ratio and compare it to where they could be in the future and come up with a potential price target for Bank of America. So sit back, relax, enjoy the video. There is going to be some technical graphs in this video that I think are amazing and really lay out the differences between like a JP Morgan, a Bank of America, and an SVB. So I hope you guys really enjoy it. If you do, make sure you drop a like down below. And if you want to see more videos like this one, make sure you hit that sub button. Let's start off by taking a look at Bank of America's chart. So here today, and I'm recording this video on Tuesday, we actually had the inflation report and numbers came out what people and analysts are saying in line with what people were expecting. Overall, though, the market reacted in a very positive way. We could see that Wells Fargo was actually up almost 5%. Capital One was up almost 3%, Citigroup up almost 6%. So all in all, I think the market actually didn't expect numbers this great, but from Bank of America, we actually saw them spike up in the morning and then just sell off throughout the day as kind of people still are worried about the whole banking situation. Over the last 5 days, we could see that Bank of America stock is down almost 12%. Over the last month, 19%. Over the last 6 months, down 16.66%. And then over the last year, they are down almost 31%. As I was doing some research about SVB and everything that was going on with that situation, I actually stumbled across this article, and this article was published back on Monday, the 11th of April of 2022. And I wanted to read the section that I've highlighted here in yellow. US banks are expected to report increased unrealized losses from available of sale securities for Q1 of 2022 based on the year-to-date rally in interest rates, which could negatively affect tangible capital for banks and regulatory capital for the largest banks under advanced approach. Nevertheless, improved earnings generation and the convergence between book and market values of affected securities will offset capital impacts over time, with banks' capital levels remaining within ratings expectations. And basically what this article is talking about is what's going on with the market right now. So again, they're talking about this increased unrealized losses that we're seeing on banks' balance sheets, and a lot of that coming from interest rates rising in a very significant way, which causes bond prices to drop out. And a lot of these banks owning bonds, as their bond prices drop out, the assets that they actually own are dropping in value. So what we are seeing is, again, this article was posted back in April and they did not anticipate interest rates to be rising as quickly as they have. We saw over the summer months that interest rates went up by around 0.75% month over month for like 3 or 4 months in a row. And that obviously has a huge impact on bond rates. And then also we saw earnings fall off a little bit on the back half of the year. And that's really impacting what this article is touching on, of hopefully offsetting some of those bond losses. And here we have a very interesting chart that is basically comparing all of these different banks. And what we have for this blue dot is the common equity tier 1 capital ratio, which is really just a fancy term for their cash and cash equivalents. And then we are comparing that to where they are sitting at when we adjust for unrealized losses. And if you look at this, basically MTB is the best in terms of the amount of ratio of cash that they still have compared to the amount of loss that they've suffered from their bond portfolio. We can see that their cash ratio right now is sitting around 10.5%. And then when you adjust for unrealized losses, they're still sitting at around like a 9.8%, which is really, less than a 1% difference. Even when you look at JP Morgan in terms of the amount of cash and cash equivalents that they have is a little over 13%, where right now when you adjust for unrealized losses, they're sitting at around, 11.5%. And Bank of America is actually in a fairly tough spot. So their cash and cash equivalents is around 11%, but when you adjust for unrealized losses, it's all the way down at 6%. And SVB is the extreme case where you can see that their cash and cash equivalents was around 12%, but when you adjust for unrealized losses, they are actually basically at 0%, maybe a 0.3 to 0.4%. So when you look at this chart, obviously Bank of America is not in the best of positions. You could see some of these other companies that have similar types of ratios, and it just depends on a bank and really how they allocate their cash and cash equivalents. Obviously SIVB, which is SVB, Silicon Valley Bank, they had a extremely high allocation to bonds, and really that came back to bite them in a very major way. So here we have a very interesting article by JP Morgan. So JP Morgan actually published this just a few days ago, and it really goes over kind of what's gone on with SVB, but I wanted to point out these two charts in particular. So this first one we have up is balance sheet growth from Q1 of 2019 to Q4 of 2022. And SVB is over here with 250% growth in their balance sheet. When we compare that to something like JP Morgan and Bank of America, we can see that they're sitting a lot closer to this 20 to 25% mark. And that is a lot healthier amount of growth in their balance sheet, because SVB basically had to take all of that cash in a very short amount of time. They almost tripled their balance sheet in just a few years. And really, what are they going to do with that money? They need to put it into some sort of asset that's going to generate a yield. And that happens to be bonds, oftentimes for banks. So what that's turned into over the last couple of years is very, very low interest rates. And then obviously, as interest rates have shot up over the last few months, that is going to drop those asset values. Compared to a Bank of America and JP Morgan that has only experienced, around 20% growth, they can kind of distribute those cash and cash equivalents into bonds at a more, dollar cost averaging kind of way of doing it, where they will have some bonds that are around 1%, but then they'll have other 10-year bonds that are maybe around 3 or 4%. And this second chart is also very interesting. So we could see this is the uninsured share of customer deposits. So basically you have SVB here actually in second place on this one. So almost 90% of their customers' deposits were uninsured, just because they were above or had accounts above that 250,000 mark, which is what the FDIC actually insures up to. And then when you look again at Bank of America, which for some reason they have on here twice, they're sitting around 40%. JP Morgan is quite a bit higher than that. They're sitting around 60%. So again, this is just dependent on the amount of basically people that they have that have over $250,000 in their bank account. And what we can actually see from all of this is SVB collapsing could actually save the rest of these banks. So JP Morgan, Bank of America, Citi, Wells Fargo, they're all seeing a positive inflow of new clients post SVB's collapse. So all this money that was held up in SVB and maybe even in smaller banks that people are kind of worried about, that could be headed to some of these larger banks. And that could re-stabilize a lot of their balance sheets. Like we saw with Bank of America, when we jump over to this chart here, again, they had a large discrepancy between their unrealized losses and how much cash they have on site. So if they get a large influx of new customers, what they can do is basically bolster their cash position, or they could also reinvest into bonds now that are at much higher interest rates. And that could also help them by offsetting some of these losses. I want to end off the video by taking a look at their PE ratio and really where they could be headed if they were to restabilize at a PE ratio that we've seen historically. So I want to start by taking a look at their earnings. So their average earnings for 2023 is estimated at $3.42. Their low estimate is $3, and then their high estimate is $3.69. And in terms of PE ratio, we could see down here that they have kind of traded anywhere from a 15 down to like a 9, and then all the way back up to around a 16, and then kind of anywhere around this 12 mark. So it seems like they kind of tend to trade anywhere from around a 10 to 15 forward PE ratio. So what we can do with that is we can look at the current price and the potential earnings over the next year and come up with a PE ratio. So for $3.42, we're sitting at an 8.41 forward PE ratio. At $3, we're sitting at a 9.59, and at $3.69, we're sitting at a 7.79 forward PE ratio. And what we can do with that information is we can take the current price and the current PE ratio based off the projected earnings. So for this one, we are looking at a potential of the average earnings of $3.42. And then if the stock trades at a PE ratio of anywhere between a 10 and 15, like we've seen historically, we can come up with price targets. So if it were to trade up to a 10 forward PE, we would see the stock trade at $34.20, which would be almost a 20% move. And if it were to trade up to a 15 forward PE ratio, we would actually see the stock move up to $51.30, which would be a 78% move up from the current stock price. And then again, at the low estimate of $3 in earnings for 2023, we see that the stock is currently trading at a 9.59 forward PE ratio. And then if it were to trade at its historical values of around 10 to 15, we would see the stock trade anywhere from $30 to $45. And $45 would actually be a 56% move up from its current price. At the high estimate for earnings, we are actually currently trading at a 7.79 forward PE ratio. And again, if it were to trade up to around a 10 to 15 forward PE ratio, we would see the stock move anywhere from $36.90 up to $55.35. And again, that high estimate is actually a 92.45% move. So again, when we look at all these estimates of earnings, we can see that they are all in the positive. And the very low estimate, even if they only earn $3 this next year, year and they were to trade at a 10 forward P ratio, we would see them still trade up around 4%. One thing we didn't really touch on in this video is that Bank of America still has a dividend. So their dividend yield right now is sitting around 3%, and 3% is a fairly healthy dividend. Bank of America is also a stock that's owned by Warren Buffett, and I would be interested to see in his next filing if he's actually adding to his position as Bank of America has dropped off in a major way. So it's very interesting. I like Bank of America. I added a little bit to my position this weekend, and if it continues to drop down, I'll probably continue to add more. The problem is I originally actually bought into Bank of America back in 2020. So my cost basis was around $22, and now I've added some. So I'm probably sitting around a $25 cost basis right now. So I'd love to, keep it relatively low, but I think overall it's trading at a good value in my opinion. So obviously though, like I always say, do not buy a stock just because some random guy on the internet talked about it. Make sure you are doing your own research and looking into these companies on your own. So overall, I hope you enjoyed the video. If you did, make sure you drop a like down below. And if you want to see more videos like this one, make sure you hit that sub button. And I really appreciate all the support from you guys. So as always, I do want to say thank you and have a wonderful rest of your day.